Okay, investors, Stock Talk with Chris was down, but not out for the week of May 24th. Why? Well, Oak Harvest, little town of Houston here in Texas, suffered a brief, less than hour-long, but terribly disruptive spring thunderstorm that rolled straight down 290 through Memorial, the Heights, the Montrose, and the downtown financial area of Houston. We had 70 to 100 mile per hour straight line winds, and almost 1 million Houstonians were without power for a day, 750,000 without power for 2 to 4 days, and almost 75,000 still without power after a week. Our A-plus operations team, led by Chris Ayers, piloted Oak Harvest through the logistics of the power outage and got our team back up and running at full strength as quick as possible. Thank you, Chris, and the rest of your team. So that storm and the outbreak of storms throughout the Midwest causing deadly tornadoes in the rest of our country this year got me thinking about the topic. It got me thinking, is 2024 going to go down in history as the year of storms? And I'm not talking about just the weather. Investors, whether the storms are weather-related, sun or solar flare-related, politically related here or overseas, war-related in Ukraine or the Middle East, or financial market-related, is 2024 destined to be the year of storms? Because clearly the first 5 months of the year have started off on rocky footing in the areas of weather, politics, and military conflicts. Maybe it's just the energy in the universe of the peak solar cycle 25 that gave us those beautiful auroras as far south as Texas after the May sun eruptions, but something seems a bit different here in 2024. I don't know what it is. However, with all the turmoil in those areas, the one areas that most media commenters continue to predict rampant volatility for 2024, but it's not really presented itself year to date in an abnormal way is, yes, the financial markets. Year-to-date volatility in single stocks has been pretty high, particularly around earnings releases. Look no farther than the reaction to the upside when Walmart reported earnings about 2 weeks ago, and then to the downside when their competitor Target reported earnings only about a week later. Take a look at Walmart's chart for the 2 weeks into and through their earnings report. This is the 60-minute price chart of Walmart, hitting a new all-time high after their earnings report. Then take a look at the same 60-minute price chart on Target when they reported and cited a weaker consumer. Target stock is almost 40% below its all-time high. There was a high in the summer of 2021 near $265 per share post the COVID reopening spending boom. Very dramatic moves at the single stock level in very different directions. The strong are getting stronger, and the weak or laggards in the stock market continue to lag at the single stock level with huge volatility dispersion. Meanwhile, investors, the S&P 500 index sits near its all-time high, near 5325. It's up around 10% year to date with only one minus 2.5% down move to start the year, and another minus 6% down move a few weeks ago as pullbacks with very little volatility year to date. When we zoom out and look at things at the index level, financial market volatility has been declining in almost every asset class in 2024, and in many assets, it's at the lowest levels or near historic low levels ex the great volatility collapse of 2017. Let's start by looking at bond market volatility, which we've discussed many times in the past. The measurement most of us use and we like to look at is the MOVE index, which measures broad treasury bond and interest rate volatility. Remember, investors, this is where collateral for leveraged investors starts. Take a look at the daily chart in the MOVE index. It peaked in March of 2023 with the collapse of Silicon Valley Bank, and it's been more or less down and to the right for 15 months. Remember, investors, when overall treasury volatility is declining, this allows hedge funds, CTAs, and trend-following investors to take on additional leverage and margin up their returns by buying more stocks, more assets, whatever they're managing. This is a good thing until it goes too far, and it isn't. Investors, when the MOVE index is rising, leveraged investors have to de-risk and sell securities out of their portfolios, even if they don't want to do it. It's the way their risk models work and the way their prime brokers make them behave. Take a look at the weekly chart on the MOVE index going back 5 years, down and to the right. Now, below levels last seen near the short-term top in stocks at the end of 2021. This is still a bullish trend for stocks. Everyone likes to talk about stock volatility and talk about the VIX index, even though it by itself is not traded nor predictive. Well, here it is, the daily chart of the VIX index. And here's a long-term monthly chart of the same index. As one can see, the low volatility year of 2017, when the Trump tax cuts were being anticipated, spot volatility, as measured by the VIX index, rarely, if ever, gets below 12 for more than a few days. However, that doesn't mean it can't stay near 12 to 15 for months or quarters, or even years, as was the case of 2012 through 2015. And secondly, it doesn't mean you should sell all your stocks and hide in cash. However, it has meant that your marginal percentage return from that point on has likely been lower than when volatility is 20, 25, or 30 or higher. Take a look at the volatility chart of the NASDAQ 100. This one's called the VXN index, down and to the right. Now take a look at the chart of the Russell 2000 Small Cap Index, also known as the RVX index. Even it has shown the same consistent downtrend the last 12 to 18 months. Real interest rates have been rising, which has hurt the highly leveraged and unprofitable companies that most often sit in the Russell 2000. However, this index could become leadership as soon as the Fed or the markets indicate the short-term rates are heading lower, not out of desperation by the Fed, but by a relaxing of financial conditions on smaller companies. Investors, before I end, I want to leave you with some more data I found extremely useful at divining the possible future outcomes of the overall market. Here once again is a table of forward volatility futures. This is not the VIX index. These are futures on forward volatility, and these can be actually traded by investors. I watched this like a hawk, and it was instrumental in our team forecasting significant rallies post-COVID in March of 2020, as well as the rally that started in late October 2023 last year, when after declining about minus 10%, stocks started pivoting higher, while many others were talking crashes and recessions. Investors, right now, as it has for the past 8 to 10 months, forward volatility markets are saying that most of 2024 should remain calm, and that the only significant spike in volatility might come in advance of the presidential election into mid to late October. You can see that by the rise in the price of the vol futures in the October contract expiration date, where it now sits around 18, while spot volatility is around 12. Should this be shocking news to investors who study history? No, it shouldn't be, as far as the markets have followed a very standard presidential election cycle path since their lows in October 2022 through today. Those same cycles call for a summer peak between July 4th and August expiration, and about a 2-month move down into pre-election, which historically has set up a great buying opportunity in most election years. Will that happen again in 2024? I don't know, but we're not betting against it, as so far, the old normal continues to play out in 2024. For those families still hurting from the storms of 2024, be it weather-related or politically related, our thoughts and prayers are with you and your loved ones. For investors or retirees who've been focused on the storms on TV for 2024 and feel anxious or paralyzed, so far, those storms have not presented themselves in the overall financial markets at the index level. However, even if you're uncomfortable with wider range of possible equity outcomes, the Oak Harvest investment team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and a shock absorber as such for your stock portfolio. Information on this exciting new strategy can be found on our website, oakharvestfunds.com. From the whole team here at Oak Harvest, we hope you had a great Memorial Day weekend and hope you have a blessed weekend this week.